And just like that, the coronavirus fears are all behind us now. And we're back up to new all time highs. The question is everything back up? Is risk on? Is risk truly on? So I'm going to break that down and take a look at the move that we're having right now in the S&P, the technical outlook, whether or not the exhale that we've had is enough to really be able to take a bigger sustained inhale, so to speak, going forward, and what these other asset classes look like and what that tells us in terms of expectations going forward. And then how do we trade that? How do we trade a trend with red flags showing up? So we'll talk about that. And of course, look at our trade idea in an area that's had a little bit of a bounce back itself. So let's go ahead and get started. Today is Monday, February the 10th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. Look at that momentum line bouncing right back up. The intermediate line also crossing up above the market sentiment line, the green line, crossing above the orange dotted line. The near-term line, of course, staying in the upper half of the chart, so maintaining this near-term run that we've had. It's been about what now? 1, 2, 3, 4, 5 days. Typical run, 7 to 12 days. It is a higher near-term high. In fact, it's also higher than not only the last near-term high, which is down here, but the one before that. So dark green shading, green line, maintaining its bullish trend, looking pretty good. We never did get. This is not an intermediate pullback. We didn't break the 23% retracement level. In fact, I've got to activate and redraw those new highs now, right? We haven't broken the 23% retracement level, and then I can also bring the fans up as well to new highs. So kind of gives you an idea that, again, we just haven't broken through. We haven't gotten the dark pink shading and the red line, which is indicative of a intermediate pullback. In fact, we did on the Russell 2000, and you notice Russell 2000 is not nearly as bullish as the S&P 500. We did break down, and we have broken back up above. We have dark green shading again. Intermediate line has crossed above 50, but the near-term line, it did drop on this case below into the lower half of the chart and still down there. The S&P itself got up to new highs, but the Russell 2000 did not. It still didn't even get up to new highs from the past few days. So it's a little different. Market sentiment is falling. It's barely It's barely below 80. So put a little context on that one. It's not as bearish, but it's a different environment than what we're seeing on the S&P 500. The Nasdaq, of course, is what's driving a lot of this. It's at new all-time highs. Strong intermediate posture. In fact, the Nasdaq Composite almost formed a cluster. It's formed a cluster over here, and keep in mind, any cluster we get would be on a very mature intermediate run. It's not like we're beginning one. These kind of clusters are really good. These kind of clusters when you've already had a mature run are not so good. So it's kind of keep that in mind. And then finally, the Dow Jones Industrial Average. Again, like the Russell, its near-term line did fall below 50, but its intermediate posture is back up above 80. Strong dark green shading, green line. So we are bullish, and obviously we are bullish. We maintain bullishness. We're not broadly bullish, as you can see with the Russell 2000. We're not quite there. It's already been showing signs of weakness that none of the other indexes have. See, we didn't even get a yellow line on the Nasdaq, and then we briefly got dark pink shading and a red line on the Dow Jones Industrial Average, because remember, it's kind of more influenced by individual components than any of these, because it's only got 30 stocks in it, and it's price weighted, so the more expensive stocks will have a bigger influence. Whereas the S&P 500, of course, is all 500 stocks, and again, it's pretty close to its own cluster too. Again, with all 4 lines up above, and any cluster we get now, again, would be a mature intermediate. You never know where the end of it is at the time, because hindsight's 2020. But you can say, okay, well, am I 1 month into a run, or am I 4 months into a run? Well, we are now almost nearly 4 months into an intermediate run. That would qualify as a very mature intermediate trend, as a typical time frame is 1 to 3 months. You can see market sentiment too. And it's not a bad thing for this to be 4 months, because this is the first intermediate run on a long-term move. And it's been doing really well. We talked over here that we were at the beginning of a long-term move. Well, we're still in that first intermediate run. We haven't pulled back yet. And a pullback's not going to be a bad thing. I think the market's problem is it doesn't like pullbacks. This was the coronavirus fears, and all the coronavirus fears produced was a 23% pullback, and that was dire. It's produced specials on the coronavirus and its impact, and this is all we got out of that. So, again, the market kind of fears 38% retracements, but the reality is you can't trend without higher highs and higher lows. So if and when we ever do get that intermediate pullback where the intermediate line falls back below 50, then the market's going to think we're in recession again. But the reality is we'll find support right around that 38% retracement level or anywhere into that area and move from there. All right, if you're watching us on our blog, I also invite you to check out our Market Outlook live videos that we do at 3:30 Eastern Time. We do these on Monday, Wednesday. In fact, let me open this up. On Monday, Wednesday, and Fridays. We actually go through and monitor all of the trade ideas we've done in previous market outlooks and talk about them and manage them. This is what the page looks like. Again, Monday, Wednesday, and Fridays at 3:30 Eastern Time. It will always have the latest live video up, as well as all the archives that you can watch, all the old ones. You can chat during the live session with other viewers. So check that out. That's our most requested feature, one of our most requested features that we've had. We also have all of our classes scheduled over here on the right, our upcoming classes here. You get access to all of our trading rooms and our Market Outlook live videos with our monthly subscription plan. Click on this link for more access to that. And then engage with us on social media with our Market Outlook tweets and Facebook posts so that those platforms continue to promote our content and to the top of your timelines. Again, they promote content that you engage with, so we try to make that easy for you here. All right, so now let's get back to the charts and take a look at the long-term view, the S&P, and look at this week's Heikin Ashi candle. Very bullish again. Not getting above this high yet, which would be kind of the next stage of bullishness. And you can see we haven't really had this multiple week pullback yet. So that just shows how brief that pullback was here, where it was basically just a 1 week. And then last week's transition week. Still very high PPO, which measures the gap between the 50 and the 200-day moving averages by a percentage. So it's where the 50 is almost 6.5% above. It's relatively high, compared to what we've seen before. The only time we've been higher here lately was January 2018. You can see the strong moves that we've had, and that doesn't necessarily mean that we have to go down next week, but it does limit any upside gain potential. Say from when we first started this intermediate run back over here. Let's take a look at the Russell 2000's weekly chart. You can see the Nasdaq's very bullish, but look at the Russell 2000. It's not nearly looking as bullish, and it's not nearly as high. It's only 3.5%. Remember, this number is apples to apples, so not nearly as bullish as we have been before. You look at again January 2018, and even into October. We still really haven't taken off yet in terms of risk appetite. Last week's this transition week, and we're very, very small candle this week. So when it talks about how there's still some the market is bouncing from these coronavirus fears, just because the S&P never pulled back doesn't mean that risk appetite didn't pull back, as you'll see later in some of these other asset classes. A lot of other things did, even if the S&P didn't, because of a handful of very large companies that kept it afloat, and not only afloat, but near its all-time highs. Let's take a look at the 3 green arrow chart for the S&P 500, and of course, we've got 3 green arrows still. You look at its 2-line versions, and you can see that 8-day, we are trading up above the 8-day moving average again. It's rising, and it's rising above the 17-day with the rising MACD and stochastics. But keep in mind the divergences, as I mentioned on Friday, the divergences in all these oscillators are setting up that now that we're already to higher highs, we're setting up with some divergences here for lower highs, and that could lead us into a, like this one here. We had not as dramatic, but this, higher highs over here with the lower highs, and then you look at the same thing on the two-line versions of the S&P. So I need to go back a little bit further so you can see this one. Higher highs with the lower highs on the oscillators looking very similar. So that's how that is how divergences can lead to more of an intermediate pullback. You can see once we broke through the lower low, and of course if we break through the lower low here, then you've got room to drop down towards that 38% retracement level once you break through that low point. So that's something to keep. Those oscillators, those divergences are definitely something to keep an eye on. When you look at like the DMI indicator, you see the same thing. You see higher highs, but the directional index, positive directional index, which is the blue line, is forming lower highs. So another instance, again, similar to over here, where we were getting progressively lower highs with higher highs. Same thing over here, higher highs with progressively lower highs that led us into that intermediate pullback there. Now let's look at the intraday charts for the S&P, and again you can see the move up to higher highs kind of breaking out there. You can see where some big strong volume nodes, including the point of control, is, as well as where the value area is. So we are in that path of least resistance right now. You can see again where these gaps are that we've talked about before, and the progressively lower volume, which is not surprising as we go up higher here. So we're kind of gradually moving up, slowly moving up. And here let's change this actually to an hourly chart. You can also see too on the 90-day basis, the value area here and the point of control, and how that relates to this run, this intermediate run that we've been on, and how far away we are getting from quote unquote the ground, so to speak, on the S&P. It's just, and this is the daily chart. I mean, this would be the ground, right? That big chunk of volume over the past year, and we've got some volume in these areas, but not nearly the same level of support. So that's something to keep our eyes on any pullbacks eventually that we do get. And there will be a catalyst. There will be within an intermediate pullback. There's always a catalyst. This coronavirus could have been one, and maybe still will be one, but as of right now is not. But there will be a catalyst. There's always a catalyst that makes the market think the world's going to end, and that's what brings us down here. So if and when that catalyst does appear, you can kind of get an idea of what would be holding us up, and there's not very much volume holding us up. So any pullback down would start to build up more of a base. As we we'll lose this chunk of volume right here, and actually bring up the value area, probably to starting to include this volume node where my cursor is, and then that would, again, that would be the top end of the 38% retracement, and be very likely that we could hit a floor there if we were ever to, if that catalyst ever did emerge and we had that intermediate pullback. All right, and then finally, let's take a look at the volume here for today. So we'll come here. Oh, no, not that one, the 3 green arrow chart. You can see the volume was very, very low, 42 million. The trading range was slightly above the average at 3.5 points. So when we put those numbers into context, 3.5 points is above the average here, and it's above 1% actually. And we're flirting with that 1% mark. And then the volume you can see was way low. 42 million is way, way low. So that's not exactly the best that you would like to see on a good strong bullish day like that. Finally, when you look at the volatility index here, the volatility index still hasn't really broken below 90%, where you say, okay, here we go on a new intermediate run. So we are technically still flirting with an intermediate pullback. We haven't dropped below 15, we haven't dropped below 90%. So those are some key numbers to watch here this week if we are indeed going to bounce back up here for a longer near-term run at least. All right, so what do you think? Do you agree with that technical assessment, or do you disagree? There's a link popping out right there in the top right corner of your screen. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below on why. What are you seeing? What technical indicators, macro indicators are you seeing that suggest that either you're a lot more bullish than I am, or that you're already bearish, that you're expecting more of a pullback more immediately than we are. So with that being said, again, to summarize what we're looking at here: strong trend, divergence is setting up, not enough of a red flag to say let's pull back on our bullish trades, but enough of a red flag, and the fact that we haven't had the intermediate pullback yet to say any new bullish trades, let's manage risk, right? Let's keep our risk. We should be less bullish now than we were a couple months ago, as the potential for that pullback looms over our heads. Doesn't mean that we can't be bullish. It just means that we have to be smaller, and make sure that if and when we get that pullback, we're not hit so hard that we can't be able to buy that dip whenever it does occur. All right, now let's talk about what's driving this price action, and this is where some things get a little interesting. So let's take a look at the last week that was here. So we'll come over here to the 10th, take a look at the 10-day chart. So here's your S&P 500, which has been gaining, and it's up 3.25%. The internet, all these other equity asset classes are lagging behind, but they're all outpacing treasuries, and you can see bonds and crude oil down. But look at the move that bonds have made. In fact, if I were to come back over here to this chart, the 4-week range here, and then throw on a comparison of with crude oil. So let's hit OK, and then let's look at crude oil during the same time frame. So look at the S&P 500. Not only have we broken the new highs here, compared to the highs that we had over here on January 22nd, crude oil is not anywhere close to those highs. In fact, off of this bounce right here that we've had in the past week, look at that nice little bounce there. Crude oil has not bounced. So you can see a big discrepancy here in the relationship of these two things. And the other thing too that stood out to me is the yields. And you can see again the S&P has broken up right here to new highs, and we did bounce up off these lows on yields, but not anywhere close to the highs of yield that the yields had back here. And then you can see the last couple of days where equities have rallied to new highs, yields have not. So a big discrepancy here. Another one of those divergences that we're seeing in these other asset classes. Again, when yields are falling, that means bonds are rising. Someone asked the other day, I saw a question on Twitter about why is the dollar rising at the same time the S&P, and that's not typical. It's because bonds are rising. Equities are rising, bonds are rising, the dollar's rising. That's not the most risk-on move to see the dollar currency moving as strongly bullish as it is. And that, again, that you can see that we can be bullish. The dollar and equities can be bullish together, but it usually doesn't lead to a good outcome when it does, at least for risk. As we saw, it's pressured other risk asset classes like commodities and like small cap stocks. Again, if I were to go back to that same 4-week chart here, and then do the comparison with the S&P 500 over here, and then pull up the Russell 2000 as an example. Again, you can see S&P brought up to new highs from what we had over here. The Russell 2000 has not, so there's a divergence there, and then you can see that gap has widened in the past couple of days. They were previously moving pretty closely together, and then a widening gap. So a little bit of a divergence there that suggests the risk appetite is not nearly as strong as these handful of large cap S&P companies would make us think that it is. When you look at all the S&P sectors, you can see where some of the bullishness resides. Technology hitting 3-month highs, discretionary hitting 3-month highs, communication services not quite bouncing, and materials and energy, of course, really not bouncing. Real estate up to new highs, staples, utilities pretty close to its 3-month highs. Everything else pretty sideways despite the nice little rally. So it's concentrated. The gains are concentrated in these cyclical areas but also your safe haven areas, as people are expecting this intermediate pullback, and they're kind of transitioning towards some safety, while these other cyclical areas, like the Russell 2000, not nearly as bullish. So it kind of gives you an idea of what's going on there. If you take a look at the comparison chart itself, you can see how bullish technology has been over the last 3 months. But take a look at just the last week that was here. Sorry, right there. There we go. You can see technology, industrials, and healthcare all having a pretty decent week. Utilities lagging behind, staples, energy, materials all lagging. I mean, those two especially are very dollar sensitive, so they will underperform when the dollar's moving up as much as it is. And with yields not really moving up either, you can see what's going on. You got utilities, you got real estate kind of matching or lagging a little bit behind the markets. In fact, if I just look at just yesterday alone here, you can see the biggest winner. Look at real estate kind of matching. I mean, that's not a sector that you normally see together with technology and discretionary. But also these two, remember, this is Apple and Microsoft, and this is Amazon. So it kind of shows you where the gains are coming from, as everything else is lagging behind the market, including these dollar-sensitive areas that are also economic growth sensitive areas, because you can't have economic growth without these basic materials fueling that growth. Financials also struggling, which is not typical either of another cyclical area. It's not participating as much in this particular rally, of course, because yields aren't rising. With yields not rising, that yield curve is still relatively flat, and not good for that sector until you get those yields taking off again. And when you look at the long-term view for yields, it doesn't look like they're going to be taking off anytime soon. In fact, I would venture to guess, as we've mentioned before, that yields are going to make this type of move where we hit this strong level and we came down and then we burst through to another area. Whether it's 1.25% or below 1, getting below this area 1.5. Don't be surprised if we don't come down into here and form this higher low point on the PPO that will then take off. And then, like I said, equities will really take off. But on any intermediate pullback, that's kind of what I expect to see on this particular trade. Even if it's just a double bottom in this area, there's still room for downside as we flirt with 1.5% again. All right, so that brings us to our trade idea of the day. And you saw the industrials as one of those cyclical areas that is doing well. Again, we put this trade on in our Market Outlook live session before the market closed, and that is on Tractor Supply. This is a trade that we did in class previously to the downside, but it's had a nice little reversal, and it's broken up through this new highs. It's got a good bullish pattern with 3 green arrows on its 3 green arrow chart. Nice little upward trend going on here. You can see the amount of volume that we had in this area to try to figure out this low and get this reversal going. In fact, when you look at the long-term view, we're kind of breaking above the 200-day moving average here with the Hakinyasha candle. The PPO is rising, looking like we might get a cross, a golden cross, something similar to this, to the upside. But we haven't broken through. Like, once we break through this kind of $9,900 level, that's when you got an opportunity to really be bullish and kind of trend trade this stock. Until then, you can see part of this rally that we've had did get us above this point of control. We are flirting with moving up towards the top of the value area on this. You can also see the DMI, which had been so bearish here, that bearish directional index had been so strong, but it's fallen back below 25, and its positive index has fallen back up or jumped above 20. So again, not the most directional opportunity here, but an opportunity to be bullish nonetheless. If you take a look at it, it's Ichimoku cloud as well for the stock, getting back up above the cloud now. A very good sign of strengthening, a moderately strong trend. Not we're not above 5 yet. We're not above 80 to where we can say, okay, here we go for a while. But we're getting into that area. So until we get into that area, until we kind of break out above this 100, we can take a look at, here we go, Market Outlook. We can take a look at selling the 95 put, buying the 92.5 put, trying to get at least from the $2.50 wide 58 cents, and we're getting more than enough depending upon where you get filled in here. This is what the trade looks like. So position sizing, around a full position size, so you don't have to worry about earnings here. And then you have, and again, the market trend is bullish. And then you have the maximum gain, which means going for, in this case, 450 bucks. That's the most I want to lose, as if and when we do pull back. Remember, there's a big chunk of volume right in this area that will ideally keep us above that. And if it doesn't, then we'll take a $450 loss, and that's easier to make up because that's how much we were trying to get on this. But that's where the probabilities, and it's a relatively, there's relatively high probability of success of getting that, and higher when you include that big chunk of volume that's there to help support it. All right, well, that does us for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out to take you to our forums on marketscholars.com, and let's keep this conversation going here. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group, as well as our website at marketscholars.com. Again, thank you for watching. Have a great rest of your day, everybody, and we'll see you all next time.